In this video, we are going to share a secret that very few people are aware of, where you can show a profit in the bank's eyes, but a loss for the tax authorities. What's up guys, it's Louis here, hope you're doing great. In today's video, we are going to talk about how to pay no taxes on property in South Africa. I'm here with Jaco from Prosperity Enterprises today, and he's going to help us with some tips and guidance on taxes. We're going to talk about ways to reduce taxes legally, tax deductibles, and how to reduce your taxes with refinancing. Jaco, thank you so much for joining us today. I think taxes is a topic that a lot of people talk about, and it's quite interesting to hear people always asking questions. How can I reduce taxes? How can I pay no taxes? And what is your opinion about this question? I'm assuming you get this question a lot as well.
Thank you, Louis. Taxes is such a hot topic that even the Beatles sang about it. So everybody is obsessed with paying less tax. And it's something we don't really like to do, right? We don't want to pay more tax than we should. However, it's important that we always stay above board, that our matters, our financial affairs are above board, and that we do things right. So we want to pay as little tax as possible whilst doing everything legally. That being said, Louis, people are so obsessed with not paying tax that they sometimes forget to make money. There's something worse than paying tax, and that is not paying tax. Because if you're not paying tax, you're not making any money. So paying tax is a good thing. If you are paying tax, it means you are making money. Once we get there, secondary, we can now start looking at how do we reduce our taxes to as little as possible. But don't focus on that primarily. Focus on making money first. Once you are making money, you can now start focusing on paying as little taxes as possible.
Yeah, it's actually a good problem to have, to struggle with taxes.
Absolutely.
Because it means you're making money.
Absolutely.
Jaco, I think that's a great mentality to have. And, one of the biggest questions I get asked is, how can you actually reduce your taxes with property? What are the things that you can use at your advantage to pay little to no tax when it comes to investing in property?
The first thing that I tell my clients is to run your property portfolio like a business. Make sure that you've got an entity that owns your properties, that you have a bank account for that entity, and that you have financial statements for that entity. The moment you do that, you separate business from you. You separate investment from you. You separate your property portfolio from you. Now you can start putting all the expenses through the business, through the entity's bank account, that could be tax deductible. There are a lot of expenses that are tax deductible that we can deduct from the rental income that we generate in a property portfolio to reduce our taxes that we're going to pay on our net profit. So just quickly to explain, so it's important that you have a company that owns your properties and that you then have a holdings trust to hold the shares of your company. So you don't want to be the owner of the company or the shareholder of the company. You want a holdings trust to hold the shares of the company, but then you want the company to own the property. Now, once that is in place, we can now start looking at what expenses we can actually put through the business. What are tax deductible expenses? Now, your biggest tax deductible expense, Louis, is of course your interest on your bond payment. That's a massive tax deductible expense that you have when you own investment property. So you want to make sure that the interest component of your monthly bond payment is deducted as a tax deductible expense. Then you've got repairs and maintenance on the property, you've got levies, you've got rates and taxes, but then there are all kinds of other costs that could potentially be tax deductible. Think about any expense that you incur that enables you to generate income for the property. Let me give you a couple of examples. If you have to fly to Cape Town for the weekend and your plan is to go look at investment property in Cape Town, that trip can be tax deductible, which means that the accommodation, the food that you eat, the Ubers that you are using to travel around, all of those could be tax deductible expenses. So there are many opportunities for you to deduct expenses that are business expenses from your income to reduce the net profit on which you are paying tax.
And I mean, getting back to it, these are all legal expenses to
That's
deduct.
right.
There's no sketchy stuff happening. There's no weird stuff going on to reduce your taxes. It's simply part of the game.
Think about it, Louis. If you have a MacBook or an iPhone that you need to use to run your business, to run your property portfolio, you could depreciate those items in your business, and that depreciation could be tax deductible.
And that's a massive advantage when it comes to property, because I mean, like for example, stocks or bonds or whatever, you don't really have tax deductibles. How can you reduce your taxes? You can't really. So with property, that's a massive advantage. We talk about refinancing a lot, and I'm not sure if you wanted to add on a bit. What can you do, or how can you use refinancing to form part of your portfolio to actually reduce taxes?
Leverage is a great way to pay less tax, because when you use leverage, the bank's money in other words, you've got interest expenses. And when you have interest expenses, that gets deducted from your rent, which means you've got lower net profit and thus lower taxes. So what a lot of property investors actually do is they intentionally keep on expanding their property portfolio. And as they get equity in their properties, they refinance those properties to make the bonds higher and the interest expenses higher. But they use that money then to buy more investment property. And by doing that, they are killing two birds with one stone. They are building more wealth and they are paying less tax.
Now, it sounds like a good deal to me. Jaco, what would you say in a practical sense if someone owns a property, let's say a normal single let, where they paid off a portion of the property and they're actually generating a positive amount of 2,000 Rand per month, for example? What is the taxes that this person can expect, or is this something that you can help reduce at the end of the day?
So what you could do in a situation like that is you can actually refinance the property with 200,000 Rand if there's equity of 200,000 Rand in the property. With 200,000 Rand additional that you are borrowing, you're probably not going to have a surplus anymore, but you're going to break even, which means your taxes are going to decrease. But now you're sitting with 200,000 Rand in your hands, and you can reinvest that money to build your portfolio further. At the end of the day, remember, your tax calculation is calculated from your rental income, less your interest on your bond, less your levies, less your rates and taxes, less your maintenance, less your admin fees in the business, like bank charges and those costs, and then also the other expenses that we spoke of. And then with the net profit that is left, that gets taxed. So we want to keep the net profit as low as possible. So here's a secret, Louis. You can actually show a profit to the bank and a loss to the tax authorities, and you can do it legally. You know how you do that? Is through revaluation. You can revalue your properties in your company, and by doing that, you show a profit. But the tax authorities don't tax a revaluation of a property. The tax authorities only tax you once you sell a property, and that's when you have capital gains tax, right? But whilst you keep the property, you don't get taxed. So you can keep the property, revalue it. It pushes you into a profit, meaning that you are showing a profit to the banks, which enables you, of course, to get better refinancing and better financing for new properties, but it gets deducted for your tax calculation again, and legally, you end up paying no tax to SARS.
That is very impressive. I think it comes down to smart accounting at the end of the day, and education, because your average guy doesn't know this. You know, when I started, I didn't know this. And I think it's a great tip, or let's call it a secret, that many people need to be aware of to improve their overall property portfolio. And for those of you that don't know, Jaco is the owner of Prosperity Enterprises, and they can actually help you with accounting. I'm not sure what are the services that you guys offer. Maybe you want to share it with the audience.
Sure, yeah. So we can help you to set up your entities, to structure your trusts, to administer your entities, be your independent trustee on your trust, and also look after the accounting of your entities. So we can do the annual financial statements for you, the tax returns, and all the administrative needs that you have.
Yeah, I think it makes so much sense to outsource work to a professional. I'm not an accountant. I don't know too much about taxes, so I outsource this work to people that know so much more than me. Jaco, thank you so much for that. Another question before we end off this video is, can you explain the concept of accumulated losses?
So the nice thing about running your property portfolio in the right structure, like for example, the holdings trust and the company structure, is that when you acquire the property, often you have losses in your first couple of years. Now, when financial statements are prepared for that company, those losses are recorded and those losses accumulate, which means that every year that you make a loss, we add that loss to the previous year's losses. That's what is called accumulated losses. Now, when you start making profit, you don't have to pay tax yet because you can actually write off those accumulated losses against your profits that you're making. And only once all of those accumulated losses are written off against the profits, then you start paying tax.
That is very cool to know. With that said, guys, thank you so much for watching. If there's anything that pops up, if there's a question that you would like to ask, feel free to leave it in the comments below, and we'll see you in the next video.